All right, good morning out there. So we are kicking off the earnings season. One of the things that I try to do in these morning briefings is teach people how to prepare for the trading day. It's kind of why I do these every day, right? A lot of people tune in just to hear the take on what I see, but when I started these, it was with a goal to teach people how to do this for yourself so you don't need me, right? That's kind of the idea behind it. So when I have an opportunity to point out something really helpful or useful, I try to take full advantage of that. And that includes certain people and personalities out there that you want to listen to when they speak. Jamie Dimon has been around for a long time. He's one of the few uh, bank CEOs that was around during the 07-08 financial crisis in the same position, the same spot. The market pays attention to what he says, and he is very good at his job. So his forward outlook is something everybody monitors. If he even hints at a particular weakness somewhere in the market or an edge somewhere, everybody chases to go look at what he's talking about and then they just pound the drum on it. So always pay attention to this guy. You can follow him on Twitter. He has speaking engagements all the time around the world. A lot of the times he's just babbling like the rest of them do. But when they do report earnings, that's when he provides that forward outlook. Pay attention to what he has to say. So what we're looking at here is JP Morgan. They had better than expected earnings, but some of their numbers wasn't quite what the market wanted. And of course, earnings being what they are, it took a little bit of a hit to the downside. We're still dealing with the global energy crisis that hasn't gone away. Talks continue. They're hoping for another meeting before the current ceasefire ends. We'll see how that goes. Until then, the market is still connected to anything to do with these talks. Every headline, the market is trying to discount that impact into tomorrow's price, and it's just whiplash out there. So continue to proceed with caution. Today we're going to get PPI, and it's one of the oldest economic indicators that we've got. Right, this thing has been around forever. Funny enough, it was first enacted by Congress as a way to see the impact of tariffs. So even though the market tends to react more to CPI than it does PPI, make no mistake about it, this number is important. You want to pay particular attention to it. And there are times where the market will really pound the table over this number. But the main thing about the number today is whether it comes in at surprise or not. They have an estimate or a forecast, and if we get that forecast number, good or bad, the market is likely to just continue to do what it was doing. It's just going to shrug it off and keep on going because it was in line with forecasts or estimates. So the real headline will be if we get a miss, if it comes in much hotter or much cooler than expected. Everybody is very focused on inflation and whether or not the Fed could hike if they needed to hike in a way to help prevent inflation. And if they can't hike, then that's going to mess up a lot of forward outlook, forward thinking, planning, expectations. So this number is kind of a big deal today. We've got a lot of Fed speakers today too, but really we're not expecting any of them to have any real impact, right? They're just chipping their teeth, talking out the side of their neck. It's very likely none of them are going to say anything new or revolutionary. It's just the same old babble. I would not discount any of them. They all have the potential to screw up and put their foot in their mouth and say something out of context, or just be taken out of context by some reporter who's there who wants to spring them with a gotcha question and then plaster headlines all over the place. It's happened before, it will happen again. So if they are speaking and there are reporters and the possibility of questions, then it's just like going to the races, right? You're not really there to watch the races. You're just there to watch for car wrecks. If they're speaking live and reporters are there and reporters can ask questions, what they have to say probably isn't going to be all that important, but watch anyways just in case they get in a car wreck. As you can see, this is where we're at, these big bars here in the middle when I jump through these different dates. This big bar is us currently, our current target rate. But look to the left and you can see the priced in rate cuts. Now, about a week and a half ago, there really wasn't anything on the left, right? Everything was on the right, or it was just one bar. So they're pricing in the possibility of more rate cuts. This is one of the reasons that the market has stayed buoyant or has gone up. Right? I think the NASDAQ is on day 9 or day 10 of positive day after day after day consecutive green days. So um, that's why they're pricing in the possibility of rate cuts. Now, it's not some 90% chance of cut. They're not that high, but we went from like nothing to 30 pretty quick. Right? A week ago it was at 16%, now it's at 30%. So it went up 50%. And that's just one in one date, and that's all the way out in January. Look a little closer. They've been running it all the way up the curve from June of this year all the way to June and July of next year. They're pricing in these cuts. That's what's helping keep the market up, even in the face of bad news and uncertainty and false headlines and everything else. It's this. Now, if they begin to unwind that, or if they just quit doing it and hold steady, what else is going to help us keep that market up? I'm not sure why. It is you, yes. So, looking at what's going on out there, silver is leading this morning, airlines behind that, Bitcoin, uranium, gold, gold miners, junior miners, chips, mags, metals and mining, emerging markets, generic tech, solar, crude. We got it all, right? Now, expanded tech and software not really doing much this morning. It's a bit weak. We'll see how that changes. Remember, the dealers and options and market breadth is not in control right now. Crude, treasuries, VIX, that's the boss. And until that changes, we can look at the sectors and the industries that are up. We can look at the market breadth. But if they're not in control, then they're not going to be the cause or the reason for the markets to be moving. We can see the CTA positioning down here. I know it's kind of a small image. Orale. That made that bigger, eh? Did you see the zero line right there? We're back to that level. So CTAs have come in buying with both fists, gobbling it up. And this is more about their positioning and less about their buying, right? I know that might sound like one and the same, but not exactly. White House risk is really light at the moment. We'll see if that changes throughout the day today, but we can see closed to press, closed, press, closed, 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 and that's all the way through the day today. So there's nothing on the table where we expect the president to be exposed to reporters and make some off the cuff comments. Of course, he has his phone, so he could do that at any time, anyways, but we can't anticipate that, right? His official schedule shows a low risk coming from the White House. Yes, we do have the threat of a liquidity gap this morning from PPI, just like we did with CPI. That's right. I just showed it the other day. That's why I didn't do the same thing again today. But yes, same risk. 830, possibility of a big move, big bar. Yep. All right, so as you can see, we are at the call wall, 69.50. We've outrun the volatility trigger and the zero gamma, and the put wall is so far away, it may as well just not exist at this point. And we've outrun all of the major moving averages. If we look out here on the daily for a moment, we can see they're all underneath us. The one that you want to keep your eye on is the 3-day, that white line. We can't often get too far away from that white line before too far is too much, and we just kind of stall out. And since that white line keeps track with us a lot, it's a 3-period moving average, so it moves fast, then the distance is pretty steady. We had the bull surge back here when price crossed the 3 and the 10. Then we just kind of stalled out a little bit. But the idea of the bull surge is to get through the 3 and the 10 and then get far enough away from the 10 that it drags the 3 up through the 10. And then we start to get everything spread out. We had a 10-20 cross the other day. And of course, with us back above the 200 and the 50, that's about as healthy as the market gets, right? Being above its 200, being above its 50 on a daily, it's a pretty healthy sentiment at that point. But we're still close enough to it and we're near it, so we could, of course, crash back down through it. We still don't have our higher low yet, all things considered. Any of these could be picked as a generic higher low, but what we're looking for is a true pullback and a good, honest higher low down here somewhere. If we look back at what that could look like in the past, right, just a nice solid reversal. Even here when we were climbing back out of that drop, we would set a level on the high side and pull back and set that higher low, right? But we got nothing. That's how strong the push has been on this reversal and this rally. That 7,000 level is the level of interest right now. So that's what we want to focus on, getting above this point. The question is, are we going to get through there without first pulling back? And on the pullback, are we going to set that higher low that we're looking for? Overnight participation at 77,000 shows that they did show up last night. They were participating even in the face of this economic data print this morning. And if you look at what we got last night, it was a whole lot of nothing. For most of the night, or at least until Europe, we had nothing, right? It was very, very boring. Then we had Europe open, a little bit of movement, and we just gave it right back up again. Came back down through the VWAP, and we're just hanging out here. We got nothing. This reinforces at a stronger level of table pounding that today's numbers could really move the market. But we don't have a market maker move showing up. They're not hedging in front of this data. They're always hedged, and make no mistake about that, but it's not additional hedging. We're basically flat this morning. We really don't have any edge towards one side or the other at this point. So nothing from that. Yesterday's narrow floor pivot channel implied that if we break out, it sticks, and we likely keep it and keep going. And of course, we had a breakout to the downside, ran all the way back up through Friday's levels, and then a breakout to the upside. And then, of course, the continuation from there. Today's floor pivot is not much higher than yesterday's. Even after all of that, the floor pivot today is just really not much more. But the channel width is very large. A wide channel implies that if we break out, it doesn't stick and we go back in again. Now, what it's referring to on if we break out is yesterday's range. So take it out to the daily just to make things easy. This is yesterday's range, right? That's a daily candle. So this big channel implies if we break out of yesterday's range, it doesn't stick and we end up going back inside and closing inside of yesterday's range. Keep in mind that that channel doesn't make price do anything. It's just giving us some insight on what to expect out of price today. And we have broken out of yesterday's range, and so far we're keeping it. We'll see if that holds through the day or not. We also have an MDP, but we can't count it yet. This is the daily pivot. We haven't hit it yet. That makes it a missed daily pivot, MDP. But it won't count until the end of the day. If we do break inside of that channel at 6,900, then the floor pivot becomes the target. Get under that and aim for the bottom of the channel. Get out of that and aim for the weekly channel. If you get in the channel, then aim for the weekly pivot. There is a concern of how far away from the weekly pivot we get. For me, that concern doesn't really kick in until we're at least 3.5, and we're only at 2.5. So our distance from the weekly pivot isn't great enough yet to really concern me. Now, because of yesterday's moves, our H&R lines for today are likely going to be very wide, which means they won't be very helpful if they're just so far away. So R1 69.81 and S1, really think it's buried in there somewhere, 68.20. It's basically sitting on top of the weekly channel. There's more edge for price to go up than down, or you could say the path of least resistance is higher, not lower. This is the distance to R1. That is the distance to S1. So as you can see, there's more space here than there is here. That's the indicator suggesting the path of least resistance is up, not down. But again, these sort of indicators have no impact on price, right? It's not going to make price go up. It won't stop it from going up. It's just giving us insight. On that 7,000 target that I gave a few minutes ago, we've got a point of control that we barely interacted with here back in February. It was built the first week of February, maybe the second week. And then we interacted with it late in February, and that's it. So that point of control, keep that one on your radar if we do continue to drive to the upside and get through that 7,000 level. Otherwise, we put in some work around that 69.32 cog line, which is kind of where we're at right now. But it's muddy. We've been through here from after the level was developed. We punched through it a couple times, so I'm not looking to see too much effort there. We could build out a new zone around that 69.32 cog line. Point of control from last week is lining up with this week so far, and also so far this week. This is pretty sloppy of a profile. Not a lot of help yet. We need to see it fill out a little bit. It is interesting to note that even with that excessive push yesterday, the profile has a lot of footprints in it. We got all of this and all of that. Not like this one where it was really shallow and then it filled out, right? Because we punched through that fast. In a situation like that, if we was to come back down, we'd also likely come back down through it really fast. But we'd have to get through these speed bumps first. So we've got some structure underneath us. Usually the fear is when we move too fast is we create these liquidity gaps and then we can fall down through those gaps really quick. But if we're building structure behind us and we've got liquidity keeping up with us and we left a lot of footprints behind us, then if we did try to retrace and make our way down lower, we've got all of that old volume and old support structure underneath us. That won't stop a headline, but it'll help if we try to get some flash crash movement. $10-day, 30-minute volume profile in TPO. That 68.50 level is looking a lot better for the new point of control. The problem is we're not going to wipe these candles out that made the point of control down here. We're not going to take them out anytime soon. It's going to be days before we get to these candles, starting right there, right? So we're not going to see this volume shelf begin to decrease for a couple of days. If we want to see this point of control move up, then we have to sit in one spot and build it out. Well, we're above 68.50. We would need price to come back down, get into 68.50, and then build that level out. And so far, we don't have any expectation of that happening. But if it did, that would be what it would take to move this point of control up sooner than by default. Otherwise, we're looking at maybe the end of Thursday, getting into Friday before we take enough volume off of that level for it to move up on its own And if you think about what that would look like, that'll tighten us up quite a bit, right? We'll lose about 150 points off the bottom of this by Thursday afternoon into Friday. If we make it into next week, then this is very likely what the new profile would look like, much narrower. This point of control would be up here. And that would give us something to lean against to move higher. All right, we took out that February VPOC. We're done with that now. And the one from Friday, we're done with that. But we built a new level yesterday. So we're just going to take that line, bring it over into today's session. And it's a really big level, right? It lines up perfectly with Friday. So Friday's point of control was really close to Thursday's. And then we have Monday's. This is a really big structural level underneath this. If we make a move to the downside, that 68.50 has a lot of structure. We do not want to get a market close below 68.50. All right, as much as that push yesterday seemed extreme, we are still inside of the weekly expected move. So it wasn't too big of a move. 69.80 is this week's expected move top, and we're not there yet. We got basically another 50 points to go, 45 points. We're 2.5% above the 10-week. It's a good place to be. And it looks like we're just starting to get those higher highs that I've been looking for on this indicator. Been looking for these for half a year. So you can see the steady decline, right? When we topped out back here, lower and lower and lower. And I've been looking to break that and begin building them out the other direction. Looks like we just might finally be starting that process. Right? Lower and lower, and then higher and higher, lower and lower. You get the idea. So 2.5% above the 10-week is a good place to be, but it's not overbought. It's not overextended. It hasn't moved too far too fast, and it doesn't owe us any sort of pullback or mean reversion. So for the higher time frame, we're not overextended at all. We're just in a good, healthy place, and longs are solid here. Now on the daily, that 2% level is the level of concern. I got the line, I just drew it there to be able to have the visual. You can see that we've been to that level before, and there's times where we do stay above it, but staying above it is not the default. More often than not, we poke above it and then we fall right back down through it again. We don't hold it. When we did hold it, for an example back here, it was after we had the tariff terrors and we dropped down into those April lows, and then the president capitulated and had all those headlines with the bond vigilantes, and we started rallying out of it, right? It was a really deep drop, and it took months for us to rally back out and get out of that hole. And the whole time we had a lot of drive sustaining that. But that's not normal, right? That was a specific situation, and we can see holding above that 2% line during that situation. But more often than not, we poke above for a day, maybe two, and then we give it up and drop back down again. So you can see right now, we've been holding this now for 4 or 5 days. We're running out of time. We can't continue to hold that forever. It is worth noting the last time we had such continued push, we were able to make it back to the previous high in the S&P, right? From those April lows, we kept that drive going all the way back up to the previous highs. Plus some, but still, we kept the drive going. We had some pullbacks along the way, but it was a sustained drive to the upside. So we're past the line. It's a bit much, and this does imply that we're already extended. If we try to take another run like we did yesterday, we're going to start getting into that 3% level, and we can't keep that. There's not very many times that we got to 3% and then had another day of 3%, right? It's very rare. I think we had a little bit back here and a little bit during that April recovery that we were talking about. Doesn't happen often. And that would be my target if we continue to focus on the upside. Put that 10-day moving average on and measure how far away are we from the 10-day. And if we continue to drive to the upside today, keep your eye on how far we get from it. Right? This is a 15-minute chart. There's the 10-day on my 15-minute chart right there. Now, if your software won't put a daily indicator on your intraday chart, then just take it out to the daily. There's the 10-day. This is us. Just do it that way. Your drawing tool has the measurement in it as long as you don't hit enter. Right? You can see the little pop-up right there, 2.28% away from the 10-day. All right, looking at what's down this morning, the VIX is down. Mag 7 down, volume is down. Nat gas and generic energy. It's about what we would expect. A little bit of financials and staples, but not down enough. They don't meet our qualification. Now looking at what's up this morning. What's up? Airlines, Mag 7 up, volume UFO, which is high speculation. Bitcoin, more speculation. Gold miners, junior miners, chips, tech, quantum, more speculation. Software. We got everything we need. If market breadth was our driver, this is everything that we would need for a breakout rally day. The problem is dealer positioning, market breadth, 0-day flows. They haven't been the driver for a couple of weeks. It's been crude, VIX, treasuries, and it's still crude, VIX, treasuries. Now, don't get me wrong. If the market breadth is bullish and treasuries and commodities and VIX are not bearish, then yeah, they're going to help contribute to the drive. But you're going to want to continue to focus on the VIX and crude above all, right? That's still the number one thing that's pushing this market. And of course, headlines. But headlines are what's driving the crude and the VIX. So it comes back to that anyways. Today's no different than any other day. GTF, you got to get out of the box before you do anything else. Yesterday, the box was that narrow range of Friday. Wasn't much to it. Today, we got a much bigger box. So this is all of yesterday. And then we have the RTH of yesterday. Since all of yesterday gives us much bigger levels that we haven't even reached yet, we can set that aside and focus on just the RTH of yesterday first. And our own Globex range. So get out of our Globex range to get anything else done. I think the headlines are going to get that done for us. We're going to get PPI. That's very likely going to get us out of this very narrow box. And then we'll see what we get from there. Got to get out of that box to get anything else done. Keep in mind that if it's a liquidity gap, if you get a big green bar, it's very likely we're going to retrace that bar by the end of the day and go back to where the bar started. Same thing if it's a big red bar. It's not guaranteed, right? But liquidity examples that I've shown again and again, the initial move is not usually the final outcome. So approach with caution. That's what I got for you guys. Be careful, be safe.